We're talking about universal life insurance today. It's a permanent life insurance policy that provides both a death benefit and a cash value component, which makes it flexible enough to serve as part of a retirement strategy if it's managed correctly. Let's break it down clearly. So a universal life policy is insurance that combines life insurance protection, which is the death benefit your beneficiaries receive when you pass away. And then it's a cash value account that earns interest over time, usually tied to market interest rates or an index. You pay premiums, and part of that goes towards the cost of insurance. It goes towards administrative fees, and the rest is invested in your cash value, where it can grow tax deferred. That's universal life in a nutshell. But how it works as a retirement tool, this is how it works. It can support retirement goals because it's tax deferred. Your cash value grows tax deferred, meaning you don't pay taxes on earnings as long as they stay in the policy. It's tax-free access to cash you can borrow or withdraw from your cash value during retirement. Policy loans are typically tax-free. As long as the policy stays active, withdrawals up to the cost basis, which is the amount you've paid in premiums, are also tax-free. You can use these funds for supplementing your retirement income, covering emergencies, paying for healthcare expenses, and this makes universal life policies act like a personal tax-free savings account wrapped in life insurance. Flexible premiums, unlike whole life insurance, you can adjust your premiums and death benefit over time within limits, of course. This flexibility helps if your income changes. You can pay during high earning years and reduce payments later. So you would pay more in the years that you make more money. It's a guaranteed death benefit even while you access the cash value. Your policy still provides a death benefit to your loved ones, ensuring long-term protection. Now, there's different types of universal life. Fixed universal life has a cash value that grows at a declared interest rate set by the insurer. Indexed universal life growth is linked to a market index like the S&P 500, offering upside potential with downside protection. Variable universal life cash value is invested in mutual fund-like subaccounts. More growth potential, but higher risk. So things to watch out for. The cost. If you don't fund it properly, the policy could lapse, especially if returns are lower than projected. Loans. If not managed carefully, unpaid loans can reduce your death benefit or cause tax issues. Fees and complexity. These policies can be very complex and carry higher fees than traditional investment accounts. So those are things to think about. Here's an example. Let's say you buy an indexed universal life at age 40 and you fund it with $500 a month. By age 65, your cash value may have grown substantially, depending on market performance. You can then start taking tax-free loans of say $20,000 a year to supplement Social Security or other retirement income. Upon your death, the remaining death benefit minus any loans is paid to your beneficiaries tax-free. So that's how a universal life policy works. And it's best for people who want life insurance protection plus a retirement savings vehicle. It's good for high earners looking for tax-advantaged growth beyond 401ks or IRAs. It's good for those seeking flexible premiums and the ability to manage their policy over time. Hopefully, this has broadened your understanding of universal life insurance. Until next time, talk to you later.